Hello everyone and welcome back to the world of finance. You are watching Finance Concepts with Nikhil. Friends, in this session, we have selected a very important point of discussion, that is something about yield curve. The moment you look into this topic, yield curve, there are lots of questions in students' mind. Not just in students' mind, even people who are dealing in debt market and who are dealing in interest rate derivatives, they have a keen interest to know things about yield curve. Now what happens? Yield curve has a close connectivity with fixed income securities, what we call as bonds and debentures. It also has a close connectivity with the forward rate that are determined under forward rate agreement, that is FRA kind of contracts. So in the field of interest rate derivative, there is significance of this yield curve. In bonds and debenture valuation, or to say dealing with fixed income securities, you have application of yield curve. So let us first understand the meaning of yield curve. Now friends, what happens? We have learned in bonds chapter concept of current yield. For example, you are buying a bond today that is priced as 1000 US dollars, okay, and the coupon payment on that bond is $60. So you are earning $60 in a year by investing $1000. As a result, your yield is 6%, what we call as current yield. You have also learned that if you are holding the bond till maturity, what you end up earning throughout the period of holding is called yield to maturity. But right now we are focusing on this current yield. So as I just explained, the current yield on the bond that I have mentioned was 6%. Now what happens? The longer the maturity of the bond, the higher is the risk of the bondholder. Why? Imagine that you are an investor and you have invested your money in bond market or debt market. You have a bond in your hand which will mature in 2 years time. And what happens? The risk involved in that bond is little less. You have another bond which has remaining maturity of 10 years. The risk involved in that bond will be higher. Why? Coupon payment which is being offered by the issuer of the bond is contracted, right? In the bond contract, it is clearly mentioned that what coupon payment will be offered. Now what happens? That coupon payment being a contractual rate, being a contractual payment, that is not going to change. But the interest rate prevailing in the debt market, which is expected by the bondholder or by the investor in general, always fluctuates, right? Imagine that currently the risk-free interest rate prevailing in debt market is just 6% per annum, and the company has issued a bond which carries a coupon rate of 6%. So your bond is offering a rate of return which is what exactly prevailing in the market. However, what happens if you have purchased this bond as an investor? You have purchased this bond and you are holding this bond. Now the interest rate prevailing in the market, suppose that rises. Now what happens? You will continue to earn just 6% because you have purchased a 6% coupon rate bond, whereas other investors in the market who are now recently buying the new bonds, they are being offered 7% coupon rate. As a result, worth of your bond definitely declines, correct? If worth of your bond declines, what you are going to do? You will just try to either sell that bond or hold that bond. If you hold that bond, you continue to receive coupon payments at just 6% rate, whereas others are earning 7%. So that is your loss. If you try to sell out that bond, the worth of that bond would have declined. You will again incur loss because the value of the bond is low. You will have to sell the bond which is not going to fetch you a high price just low price. Either way you get stuck. But imagine if the bond's maturity is very close, you are not too much affected because whatever be the redeemable value of the bond, you will get it anyway in the near term. However, if the maturity of the bond is longer, that means you have to wait long time to receive that redemption value, then the risk involved in holding that bond substantially increases. As a result, the longer the maturity, the longer the remaining maturity of the bond, the higher is the risk for the bondholder. And if higher is the risk of the bondholder, obviously bondholder would also expect more returns. And therefore, a bond that has longer maturity, the issuer of the bond generally offers a higher yield to the bondholder or to the investor. So, we can simply say the bonds having lesser duration or lesser time remaining for their maturity will be offering lower yield, and the bonds that have long term, that is longer term remaining for their maturity, they would generally offer a higher yield. Now, this is a general scenario. There may be exceptions. Sometimes in a recessionary situations, even though you hold the bond for a long term, the interest rate offered in that bond or the yield that you earn in that bond may not be going higher and higher. So those are exceptional cases at their places definitely. But right now, if you look into the normal yield curve, that means the yield curve of a bond, if you are plotting this relationship of yield rate and the term remaining for maturity graphically, you would see on the x-axis we will take the time remaining for maturity. On the y-axis vertically, you would be taking the yield rate offered by the bond. So what will happen? Higher the remaining maturity, higher would be the yield rate. Therefore, this relationship will indicate a graphical trend moving upward, and this will not be a straight line, it would be a curve. That curve is called an yield curve. So friends, let us first understand that graphical presentation of yield curve. Let us first know something more about the yield curve. We will then get involved into calculations of yield rate. We will also get involved into calculations of forward rates through the available yield rates or yield curve information. So there is a lot to be learned in this video. So just keep paying attention. I want you to first focus on the screen so that I explain you the yield curve presentation graphically and some important characteristics about yield curve. Let us first try to understand how this yield rate and remaining term for maturity would create an yield curve graphically. So you can see graphically on the x-axis we have taken the term. This I am just writing as term. It is basically term remaining for maturity. This y-axis indicates the yield rate offered by the bond. We are simply calling this as yield. So as we discussed some time back, the longer the remaining term for the maturity, the higher would be the yield rate offered by the bond. So what would happen if you are presenting the relationship between the term and yield rate graphically? I told you that it will be a trend moving upward and it will not be a straight line, it will be a curve. So just understand that this curve, which is indicating an yield curve. Now look into one thing. You have the remaining term for maturity. So understand this graphical presentation very well. If it is just 1 year time for remaining maturity, the bond is offering you this much yield. If it is 2 year time remaining for maturity, obviously I am talking about the other bond, it is offering you higher yield. 3 years remaining time for maturity, still higher yield. 4 years remaining time for maturity, still a higher yield. But do you see the increment in the yield rate from year 1 to year 2 is substantial, but between year 5 and year 6 it is very low. Therefore, this cannot be a straight line moving upward, it will be a curve, and beyond a point you would see, if you keep on plotting this curve ahead, it will be mostly become flattened, right? Anyway, so through this relationship, what do we conclude? The longer the term for maturity, the higher is the yield rate of the bond. Alright friends, you would have drawn this graph and you would have written that concluding line. Let us do one thing. Let us move ahead and talk about the characteristics that we have learned through this yield curve concept. The yield curve is a curve showing several yields or interest rates across different maturities, say 1 year, 2 years, 10 years, etc. for a similar debt contract. The curve shows the relation between the interest rate and the time remaining to maturity, known as the term of the debt. The treasury bonds or government bonds for various maturities are commonly plotted on a graph which is called yield curve, and the mathematical description of this relation are often called as term structure of interest rates. Alright friends, after writing down these important points, let us move ahead and take some calculative examples where we can connect the concept of yield curve with the forward rates. Very, very important. So pay attention to this example. The yield curve indicates the following yield rates. So you have remaining maturity and yield rate. So 1 year remaining maturity, say it is 11% per annum. 2 years remaining maturity, it is 12% per annum. 3 years remaining maturity, it is 12.2% per annum. Now the example is further asking you, determine the following, that is 1/2 FRA rate, 2/3 FRA rate and 1/3 FRA rate. Alright friends, I am sure you would have finished writing the whole thing. So let us see how to approach the calculation of FRA rates. I'll give you one explanation, other things you can definitely do on your own. So just focus on this 1 year remaining maturity bond. The yield rate offered by that bond is 11%, and now the 2 year bond is offering you yield rate of 12%, and the question is asking you to determine 1/2 FRA rate. I am sure you know the meaning of this 1/2 FRA rate. Now that means you would want to borrow after 1 year. You don't want to borrow now, you want to borrow after 1 year, and you would want to borrow for a period of 1 year. Here the objective of putting this in this format, that 1/2 FRA rate. So 1/2 FRA is the contract that will initiate after 1 year and will close after 2 years from now. So the period of borrowing will be only 1 year. That means the period of borrowing starts after 1 year end, and the borrowing period will end after 2 years end from now. That means the duration of the borrowing will be only 1 year. That is how we interpret 1/2 FRA rate. So friends, if you are holding the bond for 1 year, it is giving you 11% per annum. That means just for 1 year you are earning 11%. If you are holding the bond for 2 years, it is offering you 12% for both the years on compounded basis. So what would be the second year's yield if you are holding the bond for 2 years? That is what we call as 1/2 FRA rate. So let us see how to present the calculation of the same. Let us see how to present the solution. In the solution, you would first begin with determining 1/2 FRA rate. We would say let 1/2 FRA rate be I2. Why we have written I2? Because we are finding the rate for the second year, because the rate will be effective after 1 year for a period of 1 year. So the rate that will be applicable in the second year, we are symbolizing that as I2. Now how do we find this? So imagine that you are holding the bond for 2 years. The first year yield is basically only 11% in terms of the single year remaining maturity bond. But here the bond is being held for 2 years. It is a 2-year remaining maturity bond. What would be the implied rate applicable for the second year? We do not know. We have considered that as I2. So whatever money you have invested, will have a future value of 1 plus 0.11. That is 1.11 becomes the future value factor for the first year, and the second year factor will be 1 plus I2. This will be matching with the compounded yield that you earn for a 2-year remaining maturity bond, which is offering you 12%. So you could see I have written 1 plus 0.12 raised to 2. Now when you solve this equation, you would eventually get the value of I2. That I2 value will be the 1 by 2 FRA rate. So when we solve this equation, what do we get? 1 plus I2 will be equal to this part. How we got 1.2544? It is nothing but 1.12. That is 1 plus 0.12 whole square would give you 1.2544. This 1.11 comes in the right hand side as a denominator, correct? So it is simple. This left hand side term moving to right hand side, the numerator over here would become denominator over here. You know how to solve equations, right? Now 1 plus I2 is this value. When you solve it, 1 plus I2 you get as 1.13009. So I2 will be obviously 1.13009 minus 1, that will be 0.13009, or simply 13.009%. Alright friends, you would have finished writing this much. Let us move ahead and take the second calculation, that is determining 2 by 3 FRA rate. Now this is going to be simple once you have learned how to do. So let the 2 by 3 FRA rate be I3. First of all, I would again insist that you should know the meaning of 2 by 3 FRA rate. You would want to borrow after 2 years for a period of 1 year, correct? You would want to borrow after 2 years. That means your borrowing will start at end of second year and your borrowing will terminate at end of third year. So your borrowing will remain outstanding only for 1 year period. That is gap between second year end and third year end. So you want to borrow after 2 years for a period of 1 year only. That means from now the third year is what your borrowing would remain outstanding. That is why the interest rate applicable for that we are mentioning as I3. So now till 2 years you are going to earn what? Obviously till 2 years you will be earning that rate which is offered by a 2-year remaining maturity bond, that will be 12% per annum. So it will be 1 plus 0.12, being 2-year period it will be 1 plus 0.12 whole square. But if you are holding the bond with 3-year maturity, you are going to earn something during the third year, and the yield rate for the third year is mentioned as I3. In that case, this would obviously match with the 3-year remaining maturity bond, which was offering you 12.2% as yield rate, but for 3 years compounded value it would be 1 plus 0.122 raised to 3. When you solve this equation, what do you get? 1 plus I3, this part will be this whole thing divided by 1 plus 0.12 whole square. So that will be equal to 1.122 raised to 3 divided by 1.12 raised to 2. When you solve this part, what you get is 1 plus I3 equals to 1.41246 divided by 1.2544, and 1 plus I3 finally comes to 1.12601. So I3 will be 1.12601 minus 1, that will be 0.12601 or 12.601%. Alright friends, you would have finished writing this much. Let us move ahead and now determine the third FRA rate that was applicable for 1 by 3 FRA contract. So 1 by 3 FRA rate, let that yield rate be I, or that interest rate be I. Now what we will do now is, you should first interpret 1 by 3 FRA rate. 1 by 3 FRA rate means you are going to borrow after 1 year and your borrowing will terminate at end of third year. So the duration of borrowing this time will be 2 years, and you would want to find that rate applicable for 2 years, and that rate for 2 years will be I. So 1 plus I will now be providing you the yield for 2 years, or if you are the borrower, you will have to bear that cost for 2 years on a compounding basis. So the equation sets this way: 1.11, that is 1 plus 0.11 for 1 year, into 1 plus I for 2 years. So it is 1 plus I into 1 plus I, that is 1 plus I whole square. And this part would obviously match with the yield offered by 3-year bond, that is offering 12.2%. For 3 years compounded value, it will be 1 plus 0.122 raised to 3. When you solve this equation, this side, left side, you will get 1 plus I whole square equals to this side 1.122 raised to 3 divided by 1.11. Solving this part now, so 1 plus I whole square will be 1.41246 divided by 1.11. Again, 1 plus I whole square gives you 1.272486. So if you want the value of 1 plus I, you have to take the square root of the term in right hand side. So 1 plus I would simply be square root of 1.272486. When you solve that, when you take that square root, you get the value of I as 0.12805 or 12.805%. So friends, take note of this as well, and that will be end of the solution.